We interrupt this program with some breaking news. Financial markets are currently experiencing unprecedented volatility.
You wake up today and discover that the Federal Reserve, the most powerful central bank in the world, has just made the most critical decision of the entire decade. This is not just some piece of economic news for specialists. This is something that directly affects your life. You may not have realized it yet, but the decision announced in the last few hours could change the price of the dollar, the cost of your food, your credit card, interest rates, the value of your mortgage, and even what will happen to your investments in the coming months. In today's video, you'll understand, in a simple and clear way, what was actually decided, why it happened, how it could impact the global economy, and most importantly, how you can protect yourself or even make money by taking advantage of this move. Stay until the end, because what we're about to discuss could be the turning point for your financial life. The first step is to understand exactly what the Fed did. Unlike previous decisions, where they only made slight adjustments to interest rates, this time the central bank took a major shift in direction. They signaled that the cycle of monetary tightening is over, and that, from now on, the goal is to stimulate the economy, even if that means risking higher inflation in the future. In practice, this means lower interest rates, more liquidity in the market, and more money circulating. This decision affects everyone from the big banks on Wall Street to the small investor who keeps money in bonds or savings accounts. And that's why you need to understand not only what happened, but also what to do next. Now, let's dive into the immediate effects. With lower interest rates, credit lines become cheaper. Companies can borrow more easily to expand, hire, and produce more. Consumers have easier access to financing, which stimulates commerce and can create a wave of optimism in the economy. But there's a dangerous side. The more money circulating, the higher the risk of inflation surging again. And when that happens, the cost of living rises, and those who are unprepared lose purchasing power. This is exactly where the rich stand out because they position themselves before the majority does. A critical point to understand is the impact on the stock market. When the cost of money drops, investors seek higher-risk assets, like stocks and real estate funds, to get better returns. Historically, periods of rate cuts are followed by significant stock market rallies. That doesn't mean you should go out and buy any stock blindly, but rather that this is the time to study solid companies with strong fundamentals that benefit from cheaper credit. Think about sectors like technology, construction, and consumer goods, which tend to grow during periods of monetary stimulus. Besides the stock market, another sector that will be strongly impacted is real estate. With cheaper financing, many people go back to dreaming about buying their first home. This increase in demand can quickly drive prices up, creating a new cycle of appreciation. For those who invest in rental properties, this is an excellent moment to buy before prices skyrocket. But be careful. Jumping into a mortgage without a proper plan can become a trap if inflation rises again and maintenance costs go up. Another point you need to consider is the dollar. When the US lowers interest rates, the dollar tends to weaken globally, which can impact both imports and exports. For those investing in international assets, it might be a good time to buy dollars while they're cheaper. For exporting companies, this could mean smaller profit margins. In both cases, understanding this dynamic is crucial to protect yourself from losses. And here's an important warning. Periods of economic stimulus come with volatility. The market goes up, down, creates panic and euphoria in a matter of days. Most people make emotional decisions in these moments, buying at the top and selling at the bottom. That's why having a plan is essential. Define how much you're willing to invest, choose quality assets, and stay disciplined so you don't get carried away by fear or greed. Speaking of planning, this is the perfect time to review your personal finances, pay down expensive debt, renegotiate rates, and build a solid emergency fund. This will give you peace of mind to take advantage of opportunities without compromising your financial security. And remember, when the Fed changes its monetary policy, the entire game changes, but those with a strategy can turn chaos into growth. Now let's talk about how you can use this situation to accelerate wealth building. One strategy is to invest in productive assets, such as dividend-paying stocks or real estate funds that generate passive income. Another is to invest in knowledge. Study economics. Understand how market cycles work and prepare to act quickly when opportunities arise. The faster you understand the signals, the bigger your advantage over the rest of the market. Finally, the most important thing, make rational decisions. The Fed's decision is not a signal to rush out and invest everything at once, but rather to position yourself intelligently. Think long-term. Diversify your investments and focus on assets that hold value even in high inflation scenarios. This way, you will be protected against risks and, at the same time, well-positioned to benefit from the economic growth to come. If this video made sense to you, subscribe to the channel, hit the like button, and share it with someone who needs to prepare for this new economic cycle. And tell me in the comments, do you think this Fed decision will boost the economy or create a new crisis? I want to hear your opinion.